All right, so I am here again, and I'm going to attempt to put out a lecture on Chapter 4 here. We'll see how that goes. Still feel about like I did last night, so I apologize. I'll be drinking water, and I've got a throat lozenge at my ready if I need it. All right, so the first thing that we address, and again, going back, what is fundamentals of cost analysis for decision making. So just, more of techniques involved here, pretty much a continuation of chapter 3, if you will. And so first thing we're going to look at here in this chapter is something called differential analysis, and how you use this differential analysis to analyze decision. And the important thing here is that differential analysis requires the user of information to look at the differences in revenues and costs when analyzing alternative actions available. And then you're comparing, let's say, a proposed project with what's going on now, the status quo. And the other thing that they talk about is that you can use this for short run decisions that are going to be discussed in this chapter, but they could be used for long run decisions as well. We're not going to talk about those. Those are in the appendix of the book. And we're kind of constrained by time since we're only on 10-week terms, so kind of have to cut it short at some point. So we're only going to be looking at differential analysis in the short run here. And so the short run is considered the period of time over which capacity will be unchanged. It's usually 1 year or less. And the other thing that they talk about is whether cash flow should be considered, well, since it's under 1 year, and when they talk about cash flow, they're talking about whether or not we should use present values and all that good stuff. Well, cash is going to be collected in 1 year or less, so no, we do not consider present values and all that stuff in our cash flows when we're considering differential analysis. All right, so when you're doing this differential analysis, as far as differential costs, you're only looking at the costs that differ between alternatives. If they don't differ, it's irrelevant. Usually fixed costs don't change, so they're irrelevant. And so the differential costs are compared between, let's say, two alternatives, and that's usually what we do, is just two to simplify things, but it could be more. and whichever provides the least costs is the alternative you pick. Now, there's this concept that you may have dealt with back in managerial accounting called sunk costs. These are costs that you've already paid and thus cannot be changed by present or future decisions. Thus, they are not relevant to the decisions that you're trying to make here. Now here they talk about differential cost versus total cost. And so what you see in the two left columns are, well, status quo and alternative columns are the total costs and revenues. And what you have in the difference column is the differential revenue and costs. And of course, costs that don't change are simply noted as zero difference. So here we have status quo that gives us sales revenue of $750, but the alternative gives us $900. So the difference is $150. Cost goes up in the alternative for variable costs, but only by 50. Therefore, the contribution margin is increased by $100. Fixed cost is going to be the same. Therefore, it's irrelevant to this decision. And because operating profit goes up $100, the alternative decision is the right decision. Now here, understand that when you're looking at things like special orders, we did this, I think, in chapter 2. We looked at a special order. And in that example, we looked at a situation where the analysts incorporated both variable costs and fixed costs, and because they incorporated fixed costs, they were going to make a wrong decision in whether or not to accept a special order that was below what they normally would price an order. They had excess capacity, and so the question was, well, you know, because we have excess capacity, we have room to do this special order. Should we accept it even though it's below our normal pricing? And so the emphasis was, well, you should not consider fixed costs or fixed costs per unit in that decision, only variable costs. Well, and so the same goes here. You must always cover your variable cost, but in the short run, fixed costs do not have to be covered for these special orders, because you're going to be paying for them anyway, whether or not you accept the special order. Now, the question here is, well, should we keep accepting these special orders in the long run, or should we only accept them on an exception basis in the short run when we have excess capacity? And the answer is, well, for special orders, these should be things that are finished, or excuse me, started and completed within 1 year. You don't want these special order deals that might, in the long run, inhibit your ability to do other projects where you can charge full price. Therefore, you don't want to continue to have a series of short-term special orders. You know, one right after the other, after another, that bleeds into successive years. The other thing that can be done in the short run is adjusting product mix and volume in a competitive market. So it can be used for that. So the question here, dealing with special orders, that you have to ask yourself is whether or not this affects other sales, or is it just a one-time occurrence? If it's a one-time occurrence, you might want to consider it. If it's going to affect your normal sales and normal production, you probably want to pass on the opportunity. So, you know, here's a little decision table that you can use for that. All right, let's get to short-term pricing decisions for special orders. So again, just like in chapter 3 and maybe 2, I can't remember, but in chapter 3 they introduced you to this company, uDevelop. And so it says here that uDevelop has received a one-time order for 500 prints at a special price of 40 cents per print. So $200 additional revenue. And this is coming from a school, a teacher who teaches photography to students. And they have a limited budget. And so they're wanting to do this for less than regular price of $50. Now, uDevelop has enough idle capacity. They're not interfering with their normal business, so they could take the order, take the offer. And so regular sales, the status quo, are 5,000 prints at 50 cents. Variable costs for those 5,000 copies are 20 cents. So a total contribution margin currently of $1,500. Fixed costs are $1,200. So operating profit for the week is, in the status quo, is 300. And so looking at the alternative, that brings in $200 in revenue, additional revenue. It adds, since it's 200, excuse me, it's 500 pictures that need to be developed times 20 cents per unit variable cost. That's going to add $100 difference to variable costs. So their total contribution margin goes up $100 because they're bringing in an additional $100 of sales revenue over variable costs. Fixed costs do not change, therefore it's irrelevant to our decision. Thus, $100 additional operating profit would be made from this special order. Now, if we had somehow considered fixed costs into the mix, let's say we were doing this on a per unit basis like what we saw previously in chapter 2, and we added a fixed cost per unit component to this, well, our answer would probably be different. So we should accept this order. Whoa. Now there may be other reasons why they might want to accept this order, even if it was a break-even sort of deal. No revenue, no additional revenue were to be made from this special order. The main thing is goodwill to the school on behalf of a business. You're contributing to the education of students, photography students. These photography students are going to grow up and they're going to graduate, and maybe some of them will be either amateur or professional photographers, and therefore they may be future customers. So you have to consider the non-financial parts as well when you're making these decisions. Long run pricing decisions. Now here you would want to use full costs, whereas in short special order situations you would not want to use full costs, only differential costs. And so those long run pricing decisions where you use full costs for pricing decisions can be justified in 3 areas. Boy, I just keep going on and on here. So anyway, long run pricing decisions, you would use full cost where, and I'm on chapter 1 or page 122. There's a long-term contractual relationship to supply a product. There, most activity costs depend on the production decisions under the long-term contract. In that case, full costs are relevant for a long-term pricing decision. Also, when contracts for developing and producing customized products are entered into with governmental agencies. They in the contracts they specify prices as full costs plus a markup, and so um, you got to use full cost. It's required. Also, electric utilities, um, their everything's based on full cost. This is their regulatory mandate. And so as it notes here, in the long run, an organization must cover all variable and fixed costs, both manufacturing and selling. So this is why in our example, you might want to accept this, but if the teacher was coming to you develop and going, hey, can you supply us with development at 40 cents per picture in a long run or a long-term contract more than 1 year, you probably wouldn't want to do this, except maybe for the non-financial reasons that we talked about, because in the long run you have to cover both variable and fixed costs, and that includes manufacturing and selling variable and fixed costs. The other thing they talk about here is life cycle product costing and pricing. More and more, you got to consider from, you might say, cradle to grave of a product. From the time the concept is developed or thought of, all the way through R&D, design, manufacturing, and then there might be a disposal cost at the end of this product. So more and more regulations are requiring companies to take back product, or in the case of like oil and gas companies, they can incur a pretty sizable reclamation cost when they're through drilling a well. So they have to take in all those costs when they're thinking about what price are we going to charge for our product. So we're just talking about a bunch of different concepts here. Target costing from target pricing. Well, in the past, normally what you've done is you have determined the pricing of a product by using what's called price-based costing. What companies have gone to, and target price is the estimated price for the product or service that potential customers will be willing to pay. But what some companies have done is gone to target costing. And what they do here is, and target pricing is, what will the customer pay for our product? And, or another way of putting it, how much can we get out of our customer for this product? What's the maximum amount that they will tolerate without losing sales? What target costing does is says, okay, here's how much we want to charge for this product. Here's our markup. Let's say in the book says, for example, this company wants to charge $200 for this product, and they want a 10% markup. Okay, so 10% markup is $20, so you've got a profit margin of $20 on a product that you're going to charge $200 on. That means you've got to produce this product and all those other costs that are involved for $180. And then the company has to figure out how they're going to design and build this product for $180 per unit. So it's just a different way of looking at things rather than, maybe how much can we get out of our customers without losing sales. Next, they go into legal issues relating to costs and sales pricing. First, they talk about predatory pricing, which is the practice of setting a selling price of a product at a low price with the intent of driving out competition and creating a barrier to entry for new competitors, or creating an entry for new competitors, a barrier of entry. And so for the practice to be okay, so they don't talk about it in deep detail here, but I will mention some. For a price to be predatory, managers must set the price below cost so that it tends to harm competition. And so we have a set of federal laws dealing with this. These are called antitrust laws. They are considered anti-competitive. Well, what's the problem if you're setting products so low that they don't even cover your costs? Well, if you're big enough, if your market share is big enough, you're driving out the competition. You're also barring new competitors from entering the market. So once everybody else has left the market, or you've got just a couple of competitors versus what could have been several competitors, what are the remaining companies going to do when everybody else is eliminated? Well, the tendency is to start raising prices. So it's predatory. It's predatory for a lot of different reasons. It's predatory against your competitors. It could be predatory later on against your customers once you start being able to raise prices. If you're the only game in town and there's a demand for your product, you can charge pretty much what you want. Dumping, exporting a product to another country at a price below domestic cost. Now notice it says domestic cost, not the cost of the company in the other country. Now, notoriously good at this are our friends in China. They did this. They've done this in several markets, actually. They did it in the steel market. They dumped steel in the U.S. market, caused a lot of steel companies to have to shut down because U.S. steel companies could not compete because they were selling this stuff below what U.S. companies could produce it at. They also did this, meaning Chinese companies, and again, Chinese companies, Chinese government, are they one and the same? Pretty much. They really are, because this is pretty much an oligarchy where the heads of these organizations are tied to the government, and so they might, if they're not fully government owned, they might as well be. So they did this in the solar panel market too, and drove a bunch of companies to bankruptcy, American countries. So, I mean, this is a real problem. It continues, and hopefully we fight back against it by, maybe finally somebody had the courage to do something about this. We started charging tariffs on this stuff. So, hopefully at some point China will get the message, and they're not the only one. There are others, and those are not the only two industries. So, it's a problem, and it's a problem that America needs to fight rather than just simply being passive and saying, oh, well, don't do that, and then there's no consequences. If you don't back it up, they're going to continue these anti-competitive tactics and run American businesses out of business. Now you might go, well, but we, in a global economy, we want the cheapest products. Yeah, no, not necessarily. We don't want the cheapest products if it's going to ruin American industry, especially those industries that we rely on for things like national security. You want to make sure that we have a steel industry in America, and we're not relying on China to provide us steel, because someday if we run out all the U.S. companies out of the steel industry, and what happens if China declares war on us or something like that? I mean, they're not exactly our friends, the government anyway. So we need to make sure that we have vibrant industries, especially in those areas where it could be a national security interest. Price discrimination. Now, this happens all the time. We discriminate. If you're a student, um, you get preferential pricing for college games. You get preferential pricing for at some theaters and stuff like that. If you're a senior, you get that too, meaning not senior as in senior in college, but like a senior citizen. They get preferential pricing at hotels, restaurants, you name it. And so you can do that, and it's defined as the practice of selling identical goods to different customers at different prices. That's okay, as long as it doesn't turn into price gouging. So certain types of price discrimination are illegal. Any price discrimination based on or on the basis of race, religion, disability, or gender are illegal. And again, if you were to start charging in, let's say, an emergency, let's say there's a earthquake or some sort of natural disaster, and you see this with like gasoline. Question is, can gas companies start charging outrageous prices for the gas in a disaster? So that's something that state, local, and national governments need to think about. And price gouging is actually illegal. Price discrimination alone is not illegal unless it violates one of those things I just talked about. You have peak load pricing. There, what you're doing is you're setting prices highest when quantities demanded the most. And so there you're reaching your capacity to produce it. And so this happens with like not so much here because we don't there's not that many houses that have air conditioning. But you go to someplace like Arizona, Texas, Florida, where you almost have to have air conditioning in your house to survive. When do utility companies charge the most? Well, they charge the most in the afternoon, especially in the summer, because that's when they're closest to peak capacity. And so the regulatory agencies allow them to do that. Well, what about competitors who agree to fix prices on their products? Is that legal? No, that is not legal. And this is either implied or actual agreement. It goes beyond that, and I'll not get into details, but even a situation where two companies agree that they won't come into a certain territory. You know, one company says, okay, I'll take the northern territory, you take the southern territory, and we won't compete against each other in those territories that we've been designated for. The effect is the same. You're being anti-competitive in your agreement. You know, it's about the customers, not the companies. So make sure you understand that there's all kinds of legal traps you can get yourself into if you're in business, and try to avoid them. And this is one of them. All right, where are we? Man, we haven't gotten very far, have we? Okay, well, we got 10 more pages. I'm going to take a break. My throat hurts. Going to come back and start with differential analysis for product decisions.